welcome back to the deep dive.
It's truly fascinating watching how some companies, they don't just ride out these global economic shifts, they actually seem to find ways to capitalize on them.
Yeah, it really is.
And today, we're looking at Manhattan Associates. They're hitting new records, even with all the market jitters.
Hmm.
But the real question isn't just how they're doing it, right? It's what can we actually learn from their strategy?
Exactly. I mean, their
Oh.
Q2 results, they're almost like a case study
Mm.
in strategic resilience.
Right,
We're not just, looking at good numbers on a page.
right.
We need to dissect why they're focused specifically on cloud, their sales approach, and definitely their AI innovation,
Mm.
why that's creating a kind of blueprint for thriving when maybe others are just trying to survive.
Mm-hmm.
This is really about seeing past the financials to the actionable insights.
That's exactly our mission for this deep dive. We want to pull out the most important nuggets of knowledge, the key insights from Manhattan Associates Q2 2025 earnings call, and the reports that go with it.
We really want to help you understand their performance, their strategic thinking, and, well, what it all means for the bigger picture, the supply chain and commerce tech world.
And to do that, we've gone through the full Q2 earnings call transcript and also the official press release, which gives us all the financial details.
The full picture.
Exactly. The goal is to get you informed quickly but deeply on this really key player.
Okay, let's dive right into those headline numbers then, because they are genuinely impressive. They called it record second quarter results, better than expected.
Yeah.
Total revenue for Q2 2025 hit $272.4 million.
Mm-hmm.
Now, that's up 3% compared to last year's Q2. What's the one figure that really jumped out at you, and why? What bigger story does it tell?
Good question. For me, it's probably that 22% jump in cloud subscription revenue. It hit $100.4 million.
Wow, 22%.
Yeah. It's not just growth, it's proof positive that their whole pivot to the cloud isn't just working, it's actually accelerating, like really picking up speed. It fundamentally reshapes their business model towards that long-term recurring revenue.
That's a huge strategic win, right?
Massive. And on top of that, look at the remaining performance obligations RPO. Basically, future contracted revenue.
Right. The pipeline.
Exactly. That jumped 26% year over year. It blew past the $2 billion mark, hitting $2.01 billion. That signals incredible long-term visibility for them.
That RPO number, really hammers home the cloud story. And it wasn't just the top line growing either. Profitability looked really strong.
Oh, yeah. Adjusted operating profit was $101.1 million, and the adjusted operating margin, 37.1%.
37%.
Yeah, that's up 2.1 percentage points year over year. It just shows really strong operational leverage. And adjusted EPS, earnings per share, up 11% to $1.31.
Think about that margin for a second, 37%. In this sector, that is incredibly strong, isn't it?
It really is. It means for every dollar coming in, they're effectively keeping almost 40 cents as profit before, other factors kick in. It's like they're running this super lean, efficient machine, even when the wider economy is kind of sputtering.
Now, it wasn't all up, though. It's worth mentioning services revenue was down a bit.
Right. Services revenue dipped 6%, and maintenance revenue also saw a 7% decline. The company said the services dip was due to some customers, tightening budgets and pushing work out.
Which makes sense in this environment.
Totally expected, yeah. Probably a timing thing more than anything else.
Okay. So beyond the numbers, there's also a pretty significant leadership transition happening.
Mm-hmm.
Executive Chairman Eddie Capel had high praise for Eric Clark's first, 160 days as president and CEO. Said he's had a meaningful and positive impact.
Yeah.
And Capel himself is planning to step back from executive duties by January 1st, 2026, just becoming chairman of the board. What's the takeaway from such a smooth, well-communicated succession, especially when things are going so well?
Well, it just screams stability, doesn't it?
Yeah.
And a clear long-term vision. This kind of planned handover with continuity and that public backing from the outgoing leader. It gives confidence, not just to customers, but definitely to investors.
Right. It signals things are under control.
Yeah. Exactly. It suggests a really well-managed strategic long game, which is a pretty powerful message when the market's feeling a bit volatile.
That certainly paints a picture of, stability.
Yeah.
So with that kind of leadership, steadying the ship, what's really powering this growth right now?
Yeah.
The company says its business fundamentals are solid, its platform is superior.
Well, they're clearly firing on, multiple cylinders. They're driving growth three main ways. Just bringing in brand new customers.
Okay.
Cross-selling more stuff from their unified portfolio to the clients they already have.
Makes sense.
And converting those long-time on-premise customers over to the cloud. And what really stands out is their win rate. They're reporting over 70% wins against their top 5 competitors.
That's 70%. That's dominant.
It's a huge validation of their product, yeah.
And it's interesting how they're getting those new customers, too. Over 70% of the new cloud bookings in Q2 were actually net new logos, brand new clients.
Right. Now, they did say they expect that to kind of normalize, maybe down to about a third over time, as new logos are about 35% of their current pipeline.
Okay.
But still, it shows a really healthy customer acquisition engine working right now. They're not just farming the base.
And they're not just focused on one sector either.
No, not at all. They made a point of highlighting how diverse their customer base is. Retail, grocery, food distribution, life sciences, industrial tech, airlines, 3PLs. It's broad.
Any specific examples they gave for Q2, just to give us a flavor?
Yeah, a few. A big global logistics and supply chain company signed up as a new customer for both MAWM, their warehouse management, and MAO, their order management.
Okay.
There was also a global luxury goods company, producer, wholesaler, retailer. They converted from on-prem to the MAWM cloud solution.
Right, the conversion piece.
Exactly. And a regional healthcare system came on board as a new customer for their supply chain planning and Manhattan ActiveScale solutions.
So, quite a mix. With all that momentum, then how are they actually keeping it going, accelerating sales? I gather they're strategically boosting sales and marketing spend.
They are, yeah. Let's kind of unpack that strategy.
Okay.
It's not just throwing more money at it. It seems quite strategic in terms of restructuring and getting the right talent. They promoted Bob Howell to Chief Sales Officer. He's a company veteran, nearly 20 years there.
Wow, okay. Knows the ropes.
Definitely. And they also brought in new strategic sales leaders focused on executive level demand generation, plus new sales leaders specifically for point of sale, POS, and transportation management, TMS.
And it's not just leadership hires, is it? I heard they went on a bit of a hiring spree for salespeople, too.
They did, yeah. Apparently, they hired more individual sales folks and product specialists in Q2 than in any single quarter over the last 10 years.
10 years, okay.
And here's the really interesting bit. A lot of these new hires are coming directly from competitors. Names like Blue Yonder, Oracle, Mad Mobile, even Walmart.
Ah, so they're bringing in that deep industry knowledge. And probably some competitive intel, too.
You'd have to assume so, right? It's a smart way to inject expertise quickly.
Okay, so strengthening the internal team.
Yeah.
What about external partnerships? How are they leveraging those for growth?
Yeah, good point. They're expanding key go-to-market partnerships. For instance, their solutions are now up on the Google Cloud Marketplace.
How does that help?
Well, it just makes it easier for companies that are already using Google Cloud. Reduces friction in procurement, deployment. It's about meeting customers where they are, making it simpler to buy.
And is it working?
Seems like it. They said their largest deal in Q2 was actually influenced by that Google partnership, and they've got a growing pipeline coming through that channel.
Okay. Any other key partnerships?
Yeah, Shopify. They've expanded that partnership. There's now a connector app for Manhattan Active Order Management available directly in the Shopify App Store.
Ah, making it easy for Shopify merchants.
Exactly. Several enterprise retailers are apparently already live with it. The goal there is faster adoption of their order management system and point of sale, tapping into that huge Shopify ecosystem. It's all about that seamless integration.
Right, embedding themselves in these major platforms.
Yeah.
Now, okay, shifting gears a bit. Beyond sales and financials, tech companies live and die by innovation, right?
Absolutely.
What breakthroughs are we seeing from Manhattan, especially in AI? They're talking a lot about something called agentic.ai.
Okay, yeah, this is where it gets really fascinating, I think. So they already had this AI capability called Manhattan Assist.
Right, I've heard of that.
It's apparently handled hundreds of thousands of customer queries already, giving good answers on how the applications work, configuration help, that sort of thing.
Standard AI support, kind of.
Well, yeah, but here's the clever new twist. They've added a feature where customers can upload their own stuff, their own training docs, process maps, even annotated screenshots from their specific operation.
Oh, interesting.
Yeah. So Manhattan Assist can then give answers that are tailored specifically to that customer's distribution center or that store's way of doing things. Makes it much more useful, much more specific.
So it learns your actual environment, not just the generic software. That's smart.
Very smart. But they're not stopping there. Starting this fall, apparently each of their Manhattan Active platform applications is going to include these purpose-built agents.
Okay, agents, what do they do?
They're designed to intelligently automate and optimize specific processes. Let me give you a couple of examples they mentioned.
Please do.
Okay, think about a warehouse. They're talking about a labor optimization agent. It could, in real time, recommend reassigning warehouse workers based on the current workload, their historical productivity,
Mhm.
trying to solve that constant headache DC managers have of getting the right people in the right place at the right time.
Okay, yeah, I can see the value there.
Yeah.
What about in a store?
Right. Or in a store, maybe a store selling agent. This could give sales associates personalized selling tips in real time. It might look at the customer's past buying history across all channels, what they're buying right now,
Wow.
and even offer insights like, hey, this item is really popular online right now, or other stores nearby are selling a lot of this accessory. That kind of context-aware AI could really boost efficiency and maybe even sales.
That definitely feels like a big step beyond just answering basic questions.
Yeah.
But here's the part of their AI story that really grabbed me. The Agent Foundry.
Ah, yes, the ancient.
This isn't just about using their agents, right? It lets customers build their own.
Exactly. That's the key. Customers can get in there and define the scope, the capabilities of their own custom agents.
Hmm.
They can tweak the standard Manhattan agents or build totally new ones from scratch using APIs.
And these agents can talk to each other, even ones outside Manhattan's system.
That's what they're saying, yeah. They can interact, and that's why it feels like a potential game changer.
How so? Why is that so significant?
Because it moves way beyond a one-size-fits-all approach to AI. It empowers the customers themselves to mold the AI to fit their unique, specific operational needs and challenges. Giving them that level of flexibility and self-service for creating AI agents, that's pretty rare in enterprise software right now.
It puts the power, the customization directly in their hands.
Precisely. It's a potentially massive competitive advantage for Manhattan and for their customers who leverage it.
And speaking of advantages, let's talk about their unified product platform. That seems to be another huge success story for them. They say the message of functional and technical unification is really hitting home.
Oh, absolutely. The numbers back it up. Look at the cross-sell stats. Over the last 5 quarters, something like 80% of customers who bought their transportation management system, MATM,
Okay.
either already had or also bought their warehouse management system, MAWM, 80%.
Wow. So people buying one are very likely to buy the other.
Yeah, and they said that rate far exceeded what they ever saw with their older, non-unified platform. It really shows the power of having that seamless, integrated suite. Customers see the value.
So are they continuing to invest heavily in this unification idea?
Definitely. They have a whole engineering team dedicated just to building more unified features and advantages, and they've launched a new product council to basically co-create innovations directly with those customers who are using multiple unified products.
Getting direct feedback, building what users need.
Exactly. And apparently at their Big Momentum conference, customers were sharing stories about how unification was leading to, increased efficiency, better ROI, strategic advantages. They said the number of logos using both MAMLM and METM together more than doubled year over year.
Okay, so strong results, clear strategy on cloud and unification, exciting AI developments. What about the road ahead? They raised their outlook for 2025, right?
They did, yeah. They bumped up their guidance for full-year total revenue, operating margin, and EPS. That's based on the strong first half and what they see coming in the second half.
So what are the new numbers?
Total revenue is now expected between $1.071 billion and $1.075 billion for the full year.
Okay, cracking that billion-dollar mark solidly.
Yep. And the adjusted operating margin midpoint is up to 35% with adjusted EPS midpoint at $4.80. It's a pretty confident signal.
There was also something about taxes changing.
Yeah, a bit technical, but important. Their annual tax rate is actually going up on paper to 22.5%. That's because of changes in U.S. tax law about deducting R&D costs.
Okay, higher tax rate sounds bad.
Wait! Here's the twist. Because of how the law changed, it actually means they'll pay lower cash taxes in 2025, about $30 million lower.
$30 million less cash going out the door. That's significant.
Huge benefit to cash flow, yeah.
Now, despite all this good news, they acknowledge the global macro environment remains challenging. Volatility, uncertainty, tariffs.
Right, they're not ignoring it.
But somehow, their last 3 bookings quarters were their best 3 bookings quarters ever. That feels counterintuitive. What does that tell you about how CIOs are prioritizing spending right now?
Well, it strongly suggests that even though the overall economic weather is, choppy,
Mm,
companies are adapting. They're learning to move forward, even with some uncertainty. And crucially, they see supply chain tech not as a nice to have they can cut, but as absolutely mission
well,
critical.
strategic necessity.
Exactly. CIOs seem to view these kinds of investments as differentiators, essential for gaining strategic advantage. They're not holding back there. Plus, ongoing big projects like ERP migrations are apparently still creating a steady pipeline for companies like Manhattan.
That makes sense. But
Yeah.
I think you mentioned earlier there's a slight nuance in customer behavior, something about implementation timelines.
Yeah, that's right. While the deals are getting signed, some customers are apparently being a bit more cautious or conservative about how quickly they roll things out, taking longer ramp times for the contracts.
So the money's committed, but it might take longer to show up as recognized revenue.
Kind of. Their average contract length is still pretty long, like 5.5 to 6 years, but they noted only about 38% of their current RPO. That big backlog is expected to actually convert into recognized revenue over the next 24 months.
Okay, so there's a lag.
There's a lag, and Manhattan is actively looking at ways to help customers speed up that adoption because obviously faster adoption means faster revenue recognition for them.
Right. So if we connect that to the bigger picture,
hmm
this whole cloud conversion thing and the upcoming renewal cycle, that seems like a massive opportunity waiting to happen.
Oh, absolutely huge. Their approach so far has been pretty relaxed, let customers convert to cloud when they feel ready.
Mm-hmm.
But they did hint they might need to get a bit more aggressive on pushing those conversions to accelerate revenue. Right now, only about 20% of their on-prem customers have even started the conversion process, though many more are apparently in the pipeline.
And the renewal cycle kicks in more next year.
Yeah, particularly for their big one, Manhattan Active Warehouse Management. That cycle really starts to pick up pace next year, and that's a multi-layered opportunity for them.
How so?
Well, first, just as contracts renew, that RPO backlog naturally converts into subscription revenue. That's the basic mechanic.
Okay.
But second, when these contracts renew, they'll likely renew at higher levels. Why? Because the customers have probably ramped up, maybe added more distribution centers, more users over the initial term.
So the baseline is bigger.
Exactly. Plus, renewals are the perfect time for cross-selling. Hey, you love May WM, how about adding our TMS or our supply chain planning or maybe some of these new AI agents?
Upsell opportunities.
Big time. And of course, there's potential for straightforward price increases upon renewal too. So that renewal wave could significantly boost both RPO and future revenue.
Are they getting ready for that?
Sounds like it. They mentioned building out a global structure and teams specifically focused on renewals, even tracking them 18 months out to make sure the budget conversations and the cross-sell pitches happen well in advance.
Very proactive. Okay, so let's try and wrap this up. If we recap this deep dive, Manhattan Associates delivered really strong financial performance, right? Driven mostly by that impressive cloud growth.
Definitely. Cloud is the engine.
They're making smart strategic investments in their sales force and, crucially, in AI innovation, agentic.ai, and especially that agent foundry concept.
Yeah, the AI piece feels very forward-looking.
And they seem to have a very clear plan for future growth, powered by the success of their unified platform and this big renewal cycle that's coming up.
Absolutely. I mean, the takeaway for me is they're not just, reacting to market conditions. They seem to be actively trying to shape their future with these strategic bets on tech and talent, even when the overall environment is tough.
Okay, so here's a final thought for you to consider, something to chew on.
Yeah.
In this world that just keeps getting more complex, more uncertain, how might this ability for any company potentially to custom build its own AI agents right inside its core supply chain platform?
Mm-hmm.
How might that fundamentally change the whole competitive landscape?
Mm-hmm.
How could it redefine operational efficiency across different industries?
Mm-hmm.
It raises this question, doesn't it? It's not just about adopting AI anymore. Maybe it's about empowering your own teams to actually shape it and mold it to exactly what they need.
That is a provocative thought. Customization at that level, yeah, it could really change things.